so they can get the benefits of the policy. Yeah. Then the next key term is what we call a policy term. Now, what we're going to see is that some of the products have clear periods in which they actually work, while others, the period is not really defined. So where the period is defined, we call it the policy term. So a policy term basically dictates when the policy commences and when it ends. And there are different ways policies end. They may either end by expiring or they end by maturing. So the policy term is that period in between commencement and expiry or maturity. When we look at expiry, I'd like to explain it with other utilities that we use that do expire. For example, when you look at your umeme or your electricity, when we pay for our yaka, we pay for certain units. When those units end, the benefit of electricity expires and we have to purchase more. Or even if you have cable TV, that's GoTV, DSTV, once that payment has elapsed, the time for that payment period has elapsed, they cut you off because it has expired. So that is the same thing here when we're looking at certain policies. They do expire. And when they expire, all obligations from both parties cease. So at that point, you cannot claim as a policyholder any benefit, especially if you're still alive. I hope that makes sense. Huh? Yeah. So I don't expect any dead people coming to claim. Usually it would be the claimants who would be beneficiaries or the estate. And that would mean that they will only have rights to claim if the event of death took place within the policy term, not at the time of expiry. After expiry, they will have no rights to claim. Yeah. I hope that also has made sense to you. Yeah. Moving on, we have what we call maturity. So we initially said that the policy term can either expire or mature. So when we say it matures, we're saying that at the end of this policy term, at the end of this policy period, there are benefits to be borne by to be claimed by the policyholder if they are still alive. So if there are benefits to be enjoyed at that point, then the policy is said to mature, and benefits are meant to be paid out by the insurance company. So at maturity, usually there's a payment of a maturity value, which is usually the sums assured plus bonuses. Yeah, or if it's a policy that has no bonuses, it will just be the maturity value. And after that payment is made, all obligations cease. Yes. So the other key term we talked about was permanent disability. Now, when we look at disability in terms of insurance, and specifically in terms of life insurance, we're looking at disability not as a result of the part of the body that is injured per se, but we look at the effect of that injury, the effect of that sickness or effect of that accident on your ability to gain gainful employment or to even earn an income. So you find there are different policies that define permanent disability in different ways. Some talk about you being unable to continue to work in your own occupation, or you being unable to be gainfully employed in any occupation. So there are some diseases and some sicknesses that have that effect. If you're paraplegic and you're disabled your entire body, or I'd rather put it this way, if you find that a person may be brain dead as a result of an accident and they're just bedridden in hospital, there's no way they can undertake any occupation. So they fit in the second definition where we say any occupation. Whereas there are some sicknesses or accidents that may enable you to still get employed somewhere, but it may not be the occupation for which you were actually trained. For example, if you're a musician and you get a certain disease that affects your throat and you can no longer sing, that affects your career as a musician. So that's where this policy kicks in. But if it had the term any occupation, it means even though you can no longer sing, you can still use your hands to, say, carry for manual labor or for anything else. Yeah, so it depends on how it's defined in the policy, but we are looking at it specifically as a result of a sickness or a disease. Someone fails to be engaged in their occupation or fail to earn an income. Yeah, so now that we have covered the key terms, we have three major classes of life insurance. So when we speak of life insurance, every other product, every other policy stems from these three. These are the ones that we know of as being life insurance classes. So there is term assurance, that's the first one. And we have whole life assurance, or what is known as whole of life. And then endowment assurance. So those are the three major classes. They're the ones that we call generic classes of life assurance. So I'd like to just delve into the term assurance. For term assurance, this is the class of life insurance that pays out only on death during the policy term. It pays out only on death during the policy term. So if death occurs after the policy term, there is no payout. And what we should note that is that this kind of policy expires after the policy term is over. So it has an expiry. So for term assurance products, the client, if they're still alive at the end of the policy period, they should not expect any further benefits to be paid out because they're alive and it only pays out on death. Yes. So the primary purpose of this policy is family protection. And it's usually seen as the cheapest form because it's the simplest. Yeah. So just to depict this, I wanted you guys to see this. The arrow down here, if you can see what I'm demonstrating. The arrow down, the horizontal line, represents the policy term. So the policy term is usually fixed between 5 to 25 years. So it's a specified period of time. It's specified in the policy document. Everyone knows this policy term at the beginning because it's stated. And it's a period between commencement and expiry. And that's for term assurance. So if death occurs at any point in time within this policy term, then a sum assured is supposed to be paid out to the beneficiaries of the life assured of the policy holder, to the beneficiaries. Yes. So importance of term assurance. Term assurance can be seen as being used by families or used personally or even used by a business. When it comes to personal and family uses, when getting a loan or a mortgage from a bank, banks usually ask for insurance. And the kind of insurance they are asking for is insurance that will pay in the event that you are unable to pay because of death. And the product that works very well for this is a mortgage protection, which happens to be a term assurance product. And why it's really specific for this is because the interest in this arrangement is protection of an asset, that asset being the loan or the mortgage, and there's no interest in savings and investment. So it's purely protection. The same goes for funeral plans, where you're saying that in case death occurs, you would want all funeral costs to be covered, either for you as a person or for a family member. You'd go for a funeral plan. And the good thing with funeral plans is they tend to be affordable because they're limited to the cost of the funeral. Yeah, so they tend to be small amounts, and funeral plans can even be microinsurance products. So when we look at it in terms of businesses tend to insure their most valuable asset. We say the most valuable asset of any company or any business is the employees. So term assurance products become very important in this aspect because they cover what we call they cover what we call group life. So they cover the scheme of people under the group life in the event of death of an employee. Why is this important for the company? Now, for the company, in terms of reputation, in terms of CSR, it's important for the company to have something in place for the beneficiaries or the loved ones of their employee when they're gone. This actually provides the employee peace of mind because most of the time the employee spends their time working at the employer's premises or for the employer. So it just makes sense to give back in that way, and also to have something to give. It would be expensive to set aside that money. So the premiums paid usually tend to be at a cost saving as compared to holding money aside. It's the same thing for credit life when we're looking at banks that give out loans to a large number of groups. So this is not just a mortgage, but we're looking at, let's say, these, I'd call them unsecured loans, where you have many salaried workers who have come for loans. It tends to be take up a large portfolio of a bank's loans. So credit life becomes an important cover for the bank. Remember, at this point, the policyholder is not the person taking the loan, but the policyholder is the bank. Yeah, and it helps the bank in terms of reputation as well, because they don't need to look for the beneficiaries to pay the outstanding debt that the deceased had. Yeah, and also it sort of also protects the bank in terms of finances. Yes. Yeah. So with this, maybe there was a short question. What happens when the term assurance expires? Is anyone ready to answer this? People? Oh, we have a shy crowd. Huh? Okay, you can easily just raise your hand and Dumba can pick you. Okay, for the interest of time, I think this is a very simple question. What happens when a term assurance expires? All benefits cease for both the policyholder and the insurance company. That's what happens. So there's no payout on expiry. Yeah. So the second class, since there are no questions, we can move on. The second class is a whole life assurance policy. So this is the class of insurance that pays out only on death whenever it occurs. So when we look at this one, the issue of policy term may not really be there. And we majorly look at periods in terms of premium payment. So premium payment may be made for the whole of the life or for the premium payment period. And after this period expires, the policyholder need not make any further payments. And as a result, the policy may remain in force till until death. I see a question here from Rita. She asks, what is the difference between maturity and expiry? Okay. So I've been laboring to explain this. This is a very important difference that will help us understand whole life and term assurance. So thank you for that question. It's a very good question. So when we look at expiry, there is no payout. While when we look at maturity, there is a payout. So policies that have expiry in the sense that it marks an end of the policy. When the policy expires, there's nothing to be paid out, there are no benefits to be obtained, and that particular agreement ends like that. When we look at maturity, there is something to be paid out. There's a benefit to be obtained. So we'll see an example where there's a maturity. For now, the kind of products that we're looking at, with the term assurance and whole life, there is no maturity, but there's expiry. For the whole life, actually, you will see that it's interesting because it doesn't expire, because it pays out only, and there's no really specific policy term, because a policy term is as long as the person is living. When the person dies, the payout comes out. Okay. So when we look at whole life, the primary purpose of whole life is family protection once more. So it does have an element of saving. You're not alive at the end, but there will be definitely a payout. So you find this product is majorly used for inheritance sort of treatment, because you're looking at so long as you die, whenever it happens, is when when the policy will pay out. Yeah, so it's not like a term assurance where the term assurance has those challenges that you do not expect to be paid. For the whole life, the payment is definite because everyone is going to die at one point. So there's that assurance made. When you look at the term assurance, unfortunately, we are not so sure when we're going to die. And the policy term is specific. We know it. So death could happen within, it may not happen within. So there's that uncertainty. Yeah, so yeah, I think I just wanted to bring out that difference. So we can proceed to see an illustration. So just to illustrate this, there is no policy period. It occurs during the lifetime of the policy holder. So you can see clearly there's no specified policy term. It expires on death, but on death, there is a payout. So you can say the policy doesn't really expire. I think this is a misnomer. It continues, and there's definitely a benefit. Yeah. So for whole life, payment is assured because it's whenever death occurs. Yeah. And there's no policy term because it's during the lifetime. Yeah, I hope that is clear. I'd like to move on. Yeah, so it's important for family uses. It can be used for funeral expenses, can be used for estate planning, can be used by the surviving spouse for income. I don't see how it can supplement retirement income for the individual, but it would supplement the retirement income for the surviving spouse. The other way it may supplement retirement income is if they choose to surrender the policy. Because with the whole life assurance, it has a value as opposed to the term assurance. So with time, a whole life policy can be surrendered for a certain value, and that value can be used to supplement your retirement income. Yes. So when you look at business uses, this is really rare, death of a key person. Whole life is a policy that is usually taken out by individuals. Yeah. So I would focus majorly on the funeral expenses, really strong for estate planning, and then also for the surviving spouse's income. Then finally, we have the third and the most popular class of business for individual life in Uganda. That's the endowment assurance. And this is the class of life assurance that pays out either on death or on maturity. So this is where you see a policy maturing. So it's the most popular, just to reiterate that, and it's because people want, a little bit of both. People want protection and also want to save and invest. That's a general thing. And I'd say as Ugandans, or just generally Africans, we tend to be very optimistic about our survival. So we don't really want to hear about death. So you find that we tend to lean towards products that have more of a savings and investment element.
Yes, right.
And we fear the ones that have the protection. Yeah, though protection is big in terms of funeral in Southern Africa.
I see.
Yeah. So can move on. So just to depict it, first of all, just to mention, there is a specified policy term. So you can see from this bottom horizontal arrow that is depicting the policy term. It's usually between 5 and 25 years. It is a specific term that is known at commencement. It's specified in the policy document. It's agreed and it's known between the parties that what this policy is going to run for the next 10 years or run for the next 5 years. Yeah, so that's a policy term. And then if death occurs at any point within this policy term, then there's a payout of the sum assured. While at the end of the policy term, if the life assured is still alive, then it triggers a payout of the maturity value. Now, depending on the kind of endowment, it may pay the sum assured plus bonuses, or it may pay out what we call a maturity value. Yeah, so there are some people who would like you to mute. You have Rita, please mute. Yeah, if your microphone is on, please mute. You have Victoria also, please mute. Yeah, please mute your mics, huh? Getting feedback. Okay, there's someone else. Yes, please mute. Have Rachel, please mute. So
yes,
there's
Kevin?
a question from, yes, sorry?
I can see there is a hand here, Anena.
Yes,
Anena
I've seen
Gloria.
Anena. Yes, she may ask. It's okay.
Yes, Anena.
Yes, thank you. My question is about whole life assurance. Since you say the payment is only at death, does that go from one payment you paid once or you pay monthly?
Okay. If I got your question right, you're asking about the mode in which the payout in whole life is made. Is that what you're asking, Gloria?
Yes, sir.
Yes. Okay, so that's a discussion that is usually held at the onset. Most policies pay out a lump sum benefit. A lump sum benefit, and this is a product, since it's it's made with protection in mind. It is designed to pay out to the beneficiaries. At no point do you expect the policyholder to never die. That's the generic version of it. It's quite possible that the discussion can be held with the insurance company to have it pay out in installments at the time of payout, but that may mean either purchasing an annuity or having a drawdown sort of arrangement with the insurance company. But most products that I've seen pay out a lump sum. I hope I've answered your question.
Okay, thank you, sir.
You're welcome. Yes, so I'd like to proceed from there. We have gone through the endowments, and I don't know whether anyone has a question so far on endowments, but when you look at endowments, this is a product that's really famous in our market for child education. So you find, I think this is what you'd call the low-hanging fruit, because parents tend to be emotionally connected to their children. So it's easy to convince them to get a child educational product. But this product can also be used for personal savings, can also be used for mortgage payoffs. A majority of the endowments we see are for personal savings and for child education, where child education is by far the most popular product I've seen. Yeah. Then we have a discussion here. The first question is, what policy would you recommend for a parent who wishes to ensure no interruption in their children's education in case of death? I think we can easily tell the answer there. Okay, we have someone who wants to answer. Yeah, so Namaweje has said endowment assurance. That's very correct. It's actually also quite possible to have a term assurance, but it means that the parent here does not anticipate any problems if they survive, if they're taking a term assurance. So I think the best and most appropriate would be an endowment, so that it can also help the parents save in the event that they do survive the period. Then we have a second one, a young woman who wishes to save for a specific project, but has a child and also needs to secure future in case of death. Yeah. So that means they can take two products, but both of them would be endowments because both of them have both of the requirements here have an element of savings and death. Yeah, so it's still an endowment. So when we have a single person with no children, it means this person has dependents who are not children. I don't know what you guys would go for, given the three generic products that we have gotten to know. Yeah. So you have a single person with no children. Does anyone want to answer that? Yeah. Okay. Yeah, so we have two things. We have a question here and we have answers. So I'd like to deal with the answers first. We have term assurance as an answer for the single person with no children. Yeah, it's quite possible that the single person is just interested in their funeral expenses being covered. So from that regard, I'd agree with you guys. It's a term assurance. Though at the same time, the single person may want to save. So Mary Nalwaga says endowment. I would also say that is correct. Yeah, but it all depends on the reasoning behind. Yeah, and it depends on what the person is looking for. So I'd like to go back where we have a question from Rogers. It says, are there cases when the policy expires but doesn't mature? Yes, I'm assuming your question is in relation to endowments. Yes, it is quite possible for policy to expire. Yes, we have. Yeah, we have cases where it may actually expire and does not mature simply because the policy term is known. It's known from the onset and it's really specified, it's fixed. So if the policy continues to run, but there are actually no benefits left, then your question would suffice. Yes, it does. There are cases when that happens, but that's in relation to the fact that where the cases where the client may not be entitled to any benefits. Yeah, and that's stems from other policy conditions that you'll find in the policy document, where we say that a policy may lapse. A client may take a premium loan off the surrender value, and because of the terms and conditions, actually not premium loan, but a policy loan, and because of the terms and conditions, they exhaust their benefits under the contract. There are some contracts that are designed in a way that they do not allow the person to exhaust their benefits under the contract. So there are different scenarios, and you find that there are somewhere, of course, because you've lapsed, you will not get any benefits and your money goes like that. So the policy ends up expiring just like that because the policy term has ended. Yeah. But if you're looking at it in terms of term assurance, term assurance products have no maturity value. So those ones will have no benefits automatically. Yes. And if you're looking at a whole life policy does not expire. Yes, it does not, because it has no policy term. When death occurs is when the payout is made. Yeah. Then we had another question here. In an endowment policy, in the event of disability of the policyholder before maturity of the policy, is the selected sum assured paid with bonuses? Yes, that's a very good question. We're looking at the primary risk of these particular policies being death. So the risks that are covered under life insurance include death, disability, critical illness, and what I'd call longevity. That's living too long, and for which you'll get an annuity. So when you look at disability under these contracts, they usually come on as riders, yeah, which we shall cover just ahead. Yeah. So I'll answer. You will see the answer to your question, patients, after. Yeah. So I think the final two ones were retired couple with self-supporting children. Don't know which product they would take there. Would it be an endowment? Would it be a whole life if they're retired? Would it be a term assurance? Yeah. Oh, you say endowment. Okay. Okay.
Term assurance.
Okay. Someone has said term assurance. Thank you. We have whole life. Yes. Okay. I'd like to stop on the answers there. For this particular question, a retired couple with self-supporting children, in actual practice, you'll find that there may not be any product that may work for them on this. Sometimes a term life may be the most suitable. Endowments usually, and the rates usually start from or stop at age 70. And I'm assuming the retirement age is around 65. So these are elderly people. So usually the kind of products that they would take may not fit under any of these. Yeah, maybe a pure endowment that that is majorly just savings. Yeah, but in terms of death, the closest may be a funeral package. Yeah. So whole of life may not apply. Whole of life usually applies at the beginning of your career or mid-career when you become a bit serious. So you find a person like me who has a family with children, I become the best candidate for a whole of life. Because at this point in time, it's difficult to tell what's going to happen, and the beneficiaries are many. Yeah, so the cover that provides full protection for me is a whole of life. Yeah. For a retired couple, at this point, they are their own beneficiaries. So the spouses, the children, yes, inheritance is important, but at the same time, you may find the rating for them may stop at age 70. That's why for a retired couple, it becomes a bit tricky. Yeah, because these are people in advanced age. Yeah. So finally, for the single working parent with children, I don't know which product you would consider for a single working parent with children. Would you consider an endowment? Would you consider a term assurance? Okay, I see endowment. Okay, that's good. Anyone else wants to try? Okay. Yeah, I think any product would work actually, depending on this particular person's needs. In the previous chapter, I think you covered needs analysis, where you looked at the need to look at this person's needs and what they really want, what they're looking for, yeah, or what would actually work best for them in their particular circumstances. Yeah. So if this person has a well-paying job, regular income, they expect payment to come out they expect to retire at a particular point in time, then a specific policy may work for them better than another one. Or if you're looking at the kind of planning they have for their children, and if they require a savings element, or if they're not looking at savings, but they're looking more at protection, if where they work, they don't have, say, a group life policy and they need that serious protection, then a term life becomes more important. Yeah. So term life is cheaper than whole of life and the endowment, while endowment tends to be the most expensive. I think we can proceed from that discussion. And I'd like to cover a product that is often confused for life insurance, and that is health insurance, or what you may call medical insurance. So health insurance is the insurance coverage that pays the expenses of medical bills for the insured. So it pays the bills for the insured. So usually you find it short term in nature, that's 1 year. When a beneficiary of a medical insurance scheme or a medical insurance contract goes to the hospital, they need not have any money. It's the insurance coverage that gets them the coverage, or gets them, say, the particular benefits they're looking for at hospital, whether it's consultation, treatment, x-rays, and the different benefits that come in regards to health. That may even include drugs. So it pays for the bills. It does not restore your health. It does not pay you in case you fall sick, but it pays for the bills. Yeah. So because of that, when you look at the fact that it pays for the bills, but does not pay as a result of an event directly, then you may find that it actually follows certain principles of insurance, and these principles being indemnity. So when someone falls sick, for example, they incur medical bills, and these medical bills lead to a loss in terms of to them financially. Now, the aim of health insurance is to restore you to that position you are before you fell sick financially. Yeah. So because of that, for example, I have challenges with my eyesight. So because of that, I need spectacles. If I go to the optician, yes, there'll be a cost of consultation, the cost of the lenses, the cost of the frames. That's a loss to me because my eyes got a certain defect. Now, my health insurance comes in to pay for those bills associated with the medical costs, the health costs of my eyes. Yeah. So you find that it is actually not a class of life insurance. It's not life insurance. However, in terms of underwriting, it's very similar. When we do our risk profiling in life, we look at medical related issues as well as some financial factors, but the major underwriting comes down to medical. And as a result, you find it's similar to life underwriting, and you find life companies are able to write it as well because it's similar. Yeah, but that does not mean that it is a life class. It's actually a general insurance class, or what we call a short-term assurance class. Yeah, so the principles of indemnity, subrogation, and contribution therefore apply to health insurance. And as a result, you may find, for example, members of medical schemes may be required to co-pay. If you have two schemes, it may be affected by those particular principles. Yeah. Yeah. So we come down to the riders, and this is what I was alluding to earlier. Usually the generic product, that's a term assurance policy, the whole life policy, and the endowment cover the risk of death. The risk of death. And they cover them based on how we have defined them. You'll find that because of that, it's difficult to follow those stringent rules because life occurs differently to different people. And certain risks may impact the way the policy runs. So because of these different issues, life companies use what we call riders to tailor or customize products to be more, I'd say, more customer driven. And to meet the needs of the clients more, Some may say to sweeten the policy, but I wouldn't use that word. Yeah, but to make it more customized to the customer's needs, or more customized to the way the events occur in the general economy, to increase the demand for the product, to make it more attractive, and to make it more beneficial to the customers. That's why we have these riders. And the first one and the most common is the waiver of premium. And the waiver of premium cover in most cases is on disability. Though I have seen a waiver of premium on death, I will not go into explaining all that, but the main one is waiver of premium on disability. So just to explain that is when someone gets disabled, it does their income. And if end up being nullified because they will not be able to pay. And when you look at the kind of contracts we've looked at the term assurance. It pays on death only, not on survival. When we look at the whole life, it also pays on death whenever it occurs. And when we look at the endowment, it pays either on death or on survival. So that is the obligation of the insurance company. The obligation of the client is to pay premiums. If they fail to pay premiums, then the policy lapses. And lapsing means that the obligations of the insurance company towards the client cease. They stop. So they will no longer be able to pay out on death. They will no longer be able to pay out on maturity because the policy holder failed to pay premiums. So the interesting thing is, irrespective of the circumstances. So now this rider comes in to rectify a few issues, because we know that in life people can get disabled. People can be affected by certain things that may mean they may not be able to pay. So the insurance company is saying, because of disability, we can waive the premium and take on your obligation to pay premiums. So once a disability has been incurred by the policy holder, they can claim for a waiver of premium from the insurance company. Yeah. So this one tends to even be a standard rider on most policies. Yeah. And then when we look at double accident benefit, a double accident benefit is usually a rider that pays out the sum assured in the event that death has occurred as a result of an accident. So these particular contracts, the three that we have mentioned, they pay out on death already. So we know that death occurs, a payout happens. But what we're saying here with double accident is that in the event that this death has resulted by an accident or because of an accident, we're going to give you another payout of the sum assured, making it a double payout of the sum assured. And that's why it's called the double accident benefit. Yeah. And when we go to disability relates to what we described earlier. This is what we call permanent disability. So it's a rider that pays out in the event of a disability. This is different from waiver of premium on disability. Waiver of premium waives the premium. This particular rider for disability pays out a benefit on disability. It can be a percentage of the sum assured, usually 30%, 50% payout of the sum assured is paid in the event of disability. Yeah. So where disability is defined based on someone's ability to gain gainful employment or to continue to to earn an income. Yeah, so it depends on how the insurance company has defined it. But at the end of the day, we're looking at disability in relation to your ability to work rather than just any disability. Yeah. And the next one, sorry, we have critical illness. So critical illnesses are illnesses that are actually defined in the policy contract as being critical. Yeah. Someone needs clarity on the double accident benefit. Okay, let me just go back to the double accident. For double accident, it's a payout on death as a result of an accident. So when you look at all the generic policies in life assurance, they pay out on death. So this is whether death is a natural event or as a result of an accident. So maybe the question is, what is an accident? An accident is basically caused by an external force that is not natural, an external force. This could be a stray bullet from, say, a police officer. It could be a rock falling from somewhere, a house crashing. That is an accident. You yourself have not intended to kill yourself and you are not sick. So it was an accident. Yeah. So if that occurs, number one, because of death, there's a payout. And then there's an extra payout equivalent to the sum assured that has been paid out on death as a result of an accident. And that's why we call it a double accident benefit. I hope that is clear enough. Winnie.
The point of disability. Hello?
Okay.
Hello?
Yes, I can hear you. Please ask.
This is Patience.
Patience, yes, Patience.
Like you said,
Yes.
when the person like becomes permanently, when the policy holder becomes permanently disabled before the what? The maturity. There can't be what? The way of saving.
Okay, we're getting some feedback. Maybe Winnie, please ask your question again. Please ask your question again, Winnie.
You said that when the policy holder becomes permanently disabled before the maturity of the what? Of the policy.
Yes.
There is no payment given to him or her. What if the policy owner becomes disabled as a result of an accident? Can there be a percentage?
Okay.
Or a waiver for the remaining years?
Okay, let's look at it this way. We're looking at different riders and what they do. We're looking at different riders and what they do. So each of these riders are specific in the benefit they give out to the policyholder. Waiver of premium, number one, waives the need for the policyholder to continue to pay the premium in the event of disability. There are some cases where I've seen in the event of death. Yes, but this is majorly in the event of a disability. So irrespective of whether it's an accident or whether it's a disability caused by an illness, waiver of premium will be earned. They become eligible for it as long as it is a disability. When we look at double accident, this is in relation to death. It relates to death. Yes, there's someone's, I think, earpiece that's giving feedback. I hope it's not mine. Yes. Okay. Let me just finish this. Then we'll be able to answer your question. So for double accident is in relation to death. So it is a separate rider from waiver of premium. And then the disability rider is also a separate rider from double accident and waiver of premium, and relates to disability, whether it's as a result of an accident or as a result of natural circumstances. It will pay out as a result of the person failing to be gainfully employed or failing to get an occupation. Yes. So where the question arises, can they be paid the full amount? It is possible if the insurance company designs it that way. The challenge is that by making it the full amount, number one, you make it more expensive. Number two, making it the full amount, this is a rider, it does not change the major cover. For example, if it was an endowment, the endowment, because of disability and the fact that most endowments have a waiver of premium on disability already tagged to it, the full amount will still be paid out at the end because of the waiver. Yeah, and I think the waiver is usually important where you're looking at that need to still get the value of the policy throughout the term. Yeah. So for all these products, it's important, yes, whether it's a term, whether it's a endowment, whether it's a whole life. But when you have a separate disability cover, the disability cover is in relation to you getting disabled. It pays out immediately, while the waiver does something different. I hope I've answered the question clearly. Yeah. Then we have critical illness. There are several illnesses that we can term as critical. For example, these chronic and terminal illnesses that have, in terms of prognosis, we expect the person to have a short time to live after. If, for example, if the person is in stage 4 cancer, that would be termed as either critical or even dread disease or terminal illness. So this particular rider, in most cases, may act as what we call an accelerated benefit, where you get a percentage of the sum assured, or it can be a standalone rider where it pays out the full sum assured and still pays out on death. Yeah. Then we have renewal provision. Renewal provision is basically a condition that is set at the onset of the contract. And this is majorly for either term life or an endowment, where the policyholder wants to renew the policy later without the need for underwriting. Yeah. So probably the only consideration at that point in time is the age, where if I was 25 10 years ago and the policy has now made 10 years, I want you to renew it based on only the age, but not other conditions that I may have picked up in this period. Yeah. So renewal is, the new renewal provision is just basically recognizing that you want to have this policy for 10 years, and have a payout coming out, but at the same time you want it to continue and run for another 10 years or 5 years. So in the event that the policyholder is interested in such an arrangement, they can agree with the insurance company in case the insurance company is offering this rider for a policy to be renewed after the policy term is over, without any further underwriting requirements, especially medical. Yeah. Then we have a conversion provision. This is where a policyholder is interested in converting his term life assurance contract either into a whole life contract or even into an endowment contract without any further underwriting. Please remember that the term assurance is the cheapest. So it's me saying that right now I may not have any beneficiaries. My income is low, but I expect as I work and I grow up and I get a family and all that, my needs may change and I may want to convert to this policy. So for the onset, they first just cater for their funeral needs. And then as time goes on, they convert the policy into one that has either a savings element or one that has a more estate planning element to it, like a whole life. Yeah, then finally, we have what we call the last expense. So last expense is a policy that pays out specifically for the funeral expenses. Now, the thing about funeral expenses are usually incurred within 48 hours of the death. And when you look at how these contracts work, there may be some time lag between the payout on death and when death has occurred because the insurance company needs to investigate. So in order to assist the policyholder with those initial last expenses or funeral expenses, it's important to have this particular rider. These last expenses usually pay out a sum that is equivalent to what they anticipate the funeral costs to be. So it's not the sum assured, it's not the full sum assured. Usually you'd find between 10 million and 2 million shillings, or even less. Yeah. We have a question. So we need more explanation on conversion provision. Okay. So when you look at term life contracts are really the simplest and the cheapest. And the reason one may go for that contract is because of affordability, and also because their situation is such that they may not have any dependents per se. So just to cater for your funeral costs and such things, you have term life so that you may not be a burden to your family or extended family. You ensure that, yes, I will be buried. At least that money, guys don't need to gather mabugo for me. I've set that aside in terms of term assurance. But now, in 10 years' time, I anticipate to have a family. I cannot get that whole life right now because it's too expensive, but my income in 10 years will be such that it will afford me the benefit of paying for a better product, like the whole life. Yes. Or even it may enable me to get an endowment. And maybe also at that point, my needs may be to have an element of savings. Yeah, so it's basically to make that whole arrangement of converting your product seamless. The thing is, when your policy expires, especially a term life, it has expired, and when you're taking up a new policy, you'll be required to fill in forms. You may be required to go for medicals. You may be required to do all these things that relate to underwriting requirements. While the conversion and renewal provisions help reduce this administrative work in between. and allows you to either just to convert the policy or to renew the policy. Yeah, so conversion usually relates to term life being converted to another product. You will not have a whole life being converted. It's quite possible, yes, it can be, but in terms of riders, it is more likely for you to convert a term life, to either a whole life or an endowment. Endowments are rarely converted, because by their very nature, they're usually taken with that specified period in mind. I hope I've managed to answer your question. If you have any questions, please feel free. I think I'd covered the last expenses. So at this point, I think we need more questions because I think I've completed. Yeah.
Hi, Katete, how are you?
I'm fine, thank you.
Yeah, my name is Yanto.
Yes, Yanto.
I just want to understand the conversion provision.
Okay.
Yeah, because for me, I'm looking at it from this perspective whereby the term policy, when they come to maturity, it means definitely we're ending that relationship between between Sanlam and the client.
Yes.
But for me as a salesperson, I'm looking at it this way, like we are really missing an opportunity whereby that client could have proceeded with, for example, a life cover. So but instead of having those term policies, then why can't you not have the life endowments that don't have a maturity, how do I put this one? For example, I've chosen a term policy of 10 years, right?
Yes.
For savings. And of course, it has the life component part of it. So come the 10th year, it comes to, like, it matures. That means the relationship between myself and Sanlam is over. But what if we had made that part of the life cover whole life such that, yes, the savings component has come to an end, but you can continue with the life cover.
Okay, if I'm to understand you, you're talking about combining a whole life and a term life.
Yes, yes.
Okay, number one, the first thing we need to appreciate is a term life is purely protection. So it has no savings element.
A whole life.
A term life.
Mm-hmm.
Term life. It's important to first appreciate that. The conversion provision usually relates to a term life. So it has no savings element. So if we're looking at, say, an endowment, the endowment is the one that has a savings element.
Yeah.
And we're saying that the person is interested in converting the endowment to a whole life. And
yes,
that would mean that they want their sums assured and their bonuses paid out. And that's what we'll call savings. And then the whole life continues. That's
yes,
what you're proposing.
yes.
Yeah,
yes.
It's important to understand all the assumptions that have taken place in designing such a product. I think it is possible, but number one, it'll be actually very expensive because number one, when you look at in most, I'd call them with-profit products, there's a disparity between what we call the sum assured and the maturity value. maturity value is meant to be higher. It's meant to be as
Yeah.
a result of these bonuses being added on.
Mm.
So when it comes to pricing that, they're saying that the benefit you're getting is for surviving the period, and you're also getting another benefit in terms of sharing in the profits. However, the challenge is now you want it to continue.
Yeah.
If it is to continue, either there's number one, you having it being as a result of the cumulative premiums you paid from the beginning, or you having starting afresh, a new relationship, and the only difference being that you don't partake in the underwriting. Because that's what the conversion provisions do. They relate to those underwriting requirements. And the reason they relate to them is because our risk profiles change as we grow older. When I was younger, I didn't have any things related to ulcers or even weight. I was okay. But as I grow older, my BMI increases, my stress levels increase, hence the potential for hypertension, high blood pressure, and other age-related conditions rise. So that's why the insurance company may be interested in underwriting again, even if it's just after 2 years. They tend to be interested in underwriting because it helps them understand the risk profile of the person they're introducing. So if it is designed in that way, where the only benefit is the underwriting being taken away, it is possible for that to be done for an endowment. Yeah, but in most cases, I see it for term assurance.
Yeah, so the only reason an insurance company will not be able to allow, like for example, to have a product whereby, yes, your savings term has come to an end, but you're still alive. Why, instead of terminating that relationship, why can't we continue now covering you for the life part?
Sorry?
Hello? Hear me?
Yes, I can hear you.
Yeah, I'm saying, so the only reason that an insurance company cannot have such kind of a product, if I understand the way you have explained, is because number one, it's expensive. And then number two, for me, I was just thinking like, why should an insurance company have such kind, for example, of term policies? Why can't we have a policy whereby there's a savings component of it that can come to an end? Maybe it's 5 years term or 10 years term, but it doesn't mean that when the savings term comes to an end, then the life cover also comes to an end. Like why is it okay, or does it make sense to have a product where it can provide for the savings component and the life cover that doesn't end when the savings matures? Because the reason why I'm thinking this way, if you tell a client, we are going to cover you for a term period, for example, of 10 years, and you've picked a sum assured of 40 million, and most of our clients that we deal with, in the next 10 years, they're still going to be alive based on the life expectancy expectations. So why would a client be comfortable contributing a certain amount of premiums, and after the end of the savings component, the savings term, they are not going to get their monthly contributions for the life part? Vis-a-vis, you're telling this client, yes, you're able to save, and we're also going to give you this other part. So it's an endowment policy. You're also going to get a cover the life cover that is going to cover you, of course, until death. But when your savings term comes to an end, we're going to pay you your bonuses, but you'll continue with the life part. Such that a client is comfortable picking, for for example, a sum assured of 40 million because he knows this is the premiums I'll be contributing, they're going to be for until death. Vis-a-vis picking a sum assured of 40 million and within the premiums I've paid within 10 years and I'm alive, I'm not going to be paid out on that.
Okay, I get you now. First you have to appreciate, I'd say, the fact that we're looking at the generic products. Now, the three generic products we're looking at are the whole life,
yes,
the endowment, and the term life. So when you look at the attributes of these particular products, and I wanted to just go back to this particular slide. When you look at the attributes of the products, the term life and the endowment have a specified period of time, while the whole life has no period of time. So the first assumption you're making is that the person is going to outlive. That's the first assumption you're making. So remember, we're dealing with uncertainty and we're dealing with risk.
I know.
Yes. So whatever tweaks you'd make to this product depends on the nature of each of these generic classes. For example, I don't need to go to a term life every time I'm selling to a client, or I don't need to go to an endowment. I could actually go to a whole life and say, you know what, this is a whole life. This is the generic, covers for your whole life whenever death occurs. So the risk premium will relate to whole of life. Then whatever I attach to that, rider, last expense, if I want to even attach a savings element, I say, okay, we're going to pay out in between the whole life. It'll be based on that generic product. These are just the generic, but they can be customized to meet the needs of the client. So it is possible to do that, but now we cannot start by looking at it from the conversion provision, because the conversion provision does something specific. So you cannot use it in the way you had explained it. You can actually, you come straight to the products themselves. And say, okay, what benefit does this product provide vis-a-vis what I need to give my client as a benefit? If it's a benefit for a specified period and you're not looking beyond, you start with either your term life or endowment. If I'm looking at an element of savings, I would want to have my endowment there. Yes, I've seen term lives that have a cash back payout, but it's just a way of playing with the pricing. You play with the pricing to provide for a cash back. It's the same
from
thing.
Experience,
Yes.
Experience, and when you are looking at a product from a client's perspective, like when you really want to make the product beneficial to the client,
Yes.
is a product for whole life plus endowment better, or is the term assurance plus endowment better?
Okay. We rarely combine both of the products. What happens is we tweak the product. Actually, if you look at, for example, how would I put it? The endowment itself, I think tomorrow we're going to cover the types of insurance products. The endowment is actually a combination of a term life and what we call a pure endowment. It has two aspects, where one is protection, one that pays out on death, and then the other aspect is it pays out in terms of a savings or an investment.
Yeah.
So that's one that provides for the maturity value. Yeah. So now you may look for a client who needs both, but giving them a term assurance plus an endowment may not be the best way of looking at it. But you look at it in terms of now the riders, where the riders have specific things they do. For example, when you look at the last expense rider, the last expense rider is actually a term assurance. But what it does is it pays out specifically based on funeral costs.
Yeah.
Yeah. So it's to tweak that endowment to make it, to bring it closer to what you want for your client. I hope I've made sense.
You have, though I'm not how to explain this. Probably I'm not understanding. Because you're saying endowment, it has the life and the saving components in it, right?
Yes, it already
But it
has.
means the life component of it ends when the savings term comes to maturity, right? It comes to an end.
Yes.
No, my question is, can you have an endowment whereby the savings component comes to an end, but the life continues, the life cover continues without having it termed, like, yeah, after 10 years, it's over. Can we are you able to, is it okay for someone to come up with a product whereby it's an endowment policy, but it doesn't have a term in terms of the life part, it continues?
Yeah, what you're talking about is actually saying a whole life policy with a pure endowment element.
Yes.
It's not the other way around, because when we look at the generic covers, they relate to death. So when you look at life insurance, the major reason, as much as we say there's protection and savings and investment, the major component of the cover is protection. So you look at the element that covers the life. I hope I'm clear on that.
Yeah.
So when you look at the generic products and we say we want it to cover the life like until death occurs,
yes,
you're looking for a whole life. You cannot call it an endowment, because for endowment, when you look at the life element, it's for a specified period of time.
So you cannot
specific
have,
and it's fixed.
okay.
Yeah. If you look at a term life, it's fixed. It's a whole life that is till death whenever it occurs. So you end up looking for a whole life first. And then say, what can we do with this whole life to tweak it to the needs of our clients? We can have a waiver of premium on disability. We can have a double accident benefit. We can have a disability benefit, a critical illness renewal provision, conversion, and last expense. Now, what you're adding is you're saying you want it to have a savings element that pays out as a rider. And what I'm saying, it's quite possible, though it's not one of the riders that we consider and has no risk element to it. Now you're purely telling the client, you know what? For these 10 years, we're going to pay out this amount, and it should just relate to a savings component of their premium.
Okay, I understand it now. Yeah. And it's just that when you put yourself in a client's perspective, whereby there are two products here, that number one, that has a whole life component, that give me just an example, that give me a sum assured of 40 million, and the life and the risk premium is around 85K. And another product whereby I'm paying the same 40 million, yeah, and the risk is still the same. The risk premium is still 85K, but on the second one, yeah, on the second one, there is no there's no, like, I'm covered for, like, it's a whole life, whereby even if I'm paying this 85, I still have the life cover. So the payment of the premiums makes sense to me, because after they're going to be paid upon my death. Okay, vis-a-vis having a policy whereby I'm paying 40 million with premiums of 85, but after 5 years, the contributions I've made for 85 million drops because I'm still alive, and I'm only going to get the savings bonuses paid to me. So are you getting me from the client's perspective? Which one would you go for? Which product would you go for if they were there?
Yeah, okay. If I'm to look at it from the client's perspective, I'm looking at what covers me in every angle and gives me money sooner rather than later. That's what you're saying. Yeah. It's important to understand that insurance is really not a charity, but it's actually a business. And it's a business that deals with risk, where the client is transferring their risk to the insurance company.
Yes.
Here we're saying that we're not sure when we're going to die, and there may be financial implications of death. I'm transferring that risk to the insurance company, and I'm going to pay them a premium over a period of time. Yeah. So the kind of benefits that are paid are dependent on how the product is designed and all the elements that went into pricing for the product. Now, I don't want to get into a discussion of now product development where we're designing a product here, but it's important to appreciate the fact that it has to build from the generic and then you add the benefits. Yes, the generic being that we know that this is the risk that is a life risk. Yeah, now the benefit you want to add is a savings element that gives an earlier payout to keep the client, to engage them during the term of the policy, which totally makes sense.
Yeah.
Which I think would be a good product.
Yeah.
The first challenge, number one, by doing that, you make the product more expensive. That is what I majorly was trying to say, because they have to pay that extra premium that you're going to pay out in terms of their savings. They have to pay for it. The insurance company is not going to produce it from the air. You pay for savings in order to get the savings paid out. Then you pay for risk cover as well. Yeah, that's basically what I meant.
Yeah.
I hope I've answered you.
Yeah, you have.
Winnie, is it Patience? Okay, Patience, please help to clarify on the point you said. Still have some time. On the point you said, health is not a class of life assurance. Okay. I hope I was clear on this one. When you look at health insurance, there are things that make life insurance life insurance. Number one, when we look at life insurance, it is a benefit policy. It does not follow the principle of indemnity. And I think that was the first point I labored to make. When you look at life insurance, the major issue is that even when we talk about the costs related to death, apart from the funeral, we cannot quantify the rest. It's hard to quantify someone's value because people's value change over time. It can appreciate, it can diminish. I can become a billionaire today and be a pauper tomorrow. Yeah, so the human being's potential, as long as they're alive, is infinite. It cannot be quantified. And as a result, it's difficult to indemnify whatever dependents, beneficiaries remain behind as a result of death. Now, when we look at medical, on the other hand, medical we agree that we as insurance companies cannot restore you to health. Yes. However, what is clear is that that's also not the purpose that health insurance serves. Health insurance is to pay for the health-related costs. So yes, the risk may be, say, maternity. Is maternity really a health problem? Maybe you may affect a woman's health. But we're not saying we're going to deliver a baby for you. We're saying no, we'll pay for the costs related to delivery. We'll pay for the costs related to, say, dental issues. We'll pay for therapy, we'll pay for the laboratory tests, the x-rays. All those can be quantified. There are market prices for them. The agreement is made between the insurance company and the service provider. The client even doesn't need to know the costs in between. It's just them being told that, you know what, we'll give you benefits up to a limit of 2 million. As long as you fall sick within that range, we will be able to give you access to those benefits. So even the client doesn't get cash. Yeah, I hope I've answered the question. And yeah. So I think, are there any other questions? Patients, I hope you've understood.
Yes, Mr. Kevin.
Yes, sir.
Can you explain more about subrogation and contribution rating to insurance?
Subrogation and contribution.
Yes.
Okay. When we look at subrogation and contribution, these are what we call corollaries of it. So the important thing is first to understand indemnity before we go to subrogation, and the need for subrogation and the need for contribution. When you look at indemnity, first of all, is we're trying to prevent we're trying to maintain, but prevent is a bit negative. But we're trying to maintain the cause and the purpose of insurance, which is to restore someone to the level they were before the loss occurred. So it's a positive thing. We're trying to maintain it at you being restored. But there are situations where someone may benefit from insurance. For example, I have a vehicle and my vehicle has an accident. Usually when insurance comes in, it comes to pay for the costs of the accident. If it just gives me the money and I just receive the money and I repair the vehicle, there is a possibility I may benefit. Question is how? Just the salvage and the door that has been damaged, or even if it's the entire frame of the car, I may benefit from that by selling it, and then that may create what we call moral hazard. Because once I notice that, wait a minute, not only did I get a new car, but I got money from these other parts of the car, it sparks the need for me to get into frequent accidents. You get it? So this is to restore that particular purpose. So the insurance company exercises its rights of subrogation by gaining rights to the salvage and even pursuing a third party in the event that the third party has actually caused the accident. So that means the insured, in this case, relinquishes the rights, any further rights, as long as they have been restored to the position that they were before, and then gives the insurance company the right to go and claim from the third party. And it's the same when we look at contribution, where in this case, there's a case of over-insurance where I've gone and insured myself with several insurance companies. It's quite possible that if in the event it's not really over-insurance, but it gets me back to the level I was before, then everything is fine. The challenge always comes where, yes, say my vehicle was worth 40 million, it's a write-off, I insured for 40 million here, 40 million there, I go and claim from both. It means I will get 80 million. That seems like quite a lucrative venture. So it would encourage moral hazard if there was a possibility for me to do so. So what contribution does is it says, wait, let's correct this. Both insurance companies pay in proportion to the insurance that was taken out by the policyholder. So in the case that the level was equal, say 40-40, then the insurance companies will contribute 50-50. Where it's different, then it'll be in proportion. The one that has the higher level of insurance will pay the higher level of benefit. It will be in proportion to the kind of cover taken. Yeah, I hope you've understood.
I've got it.
Yes.
Yes, thank you.
Yeah. Any other questions? We still have some 10 minutes. Yeah.
Thank you, Kevin.
You're welcome.
Could you just clarify more on moral hazard?
This is Anena, Gloria.
Yes.
Okay, Gloria. What is moral hazard? Moral hazard is basically something that encourages, how would I put it? I don't want to call it negative behavior, but I think it's best to look at it in terms of an example. Example being anything that relates to fraudulent activity on the part of the insurance, no, not on the insurance, of the insured, where the insured seeks to fraudulently gain from the insurance. That is what we'd call moral hazard. An example of this would be where there's a benefit for, say, what's it called? I don't want to say a benefit for stealing, but if there was something in the contract that encouraged negative behavior, like stealing, for example, if we say you're paid a benefit irrespective of whether what you do is illegal or not, then that is what we'd call a moral hazard. It causes you to do something immoral. I don't know whether that makes sense. I'm using the word itself. It majorly relates to the conduct and behavior of the person involved, where the conduct is such that they are doing things that are fraudulent in nature in order to gain a benefit from the contract. That is what I would call a moral hazard. I hope you understand. Gloria.
Yes, sir. I've understood. Not trying to
Okay.
confuse.
Okay. Any other questions?
Yes,
Yeah.
Kevin. Yes, Kevin.
Yes, Suleiman.
I can see Rachel Lunyoro.
Okay.
Rachel,
Okay.
Rachel, please unmute and ask your question. Yes, Rachel.
Yes, sir.
Yeah, I can see your hand is up.
Not true.
Your hand is up. Okay.
I
All
think
right.
I need a
I can also see,
mistake because I've understood.
okay. All right. Thank you. There's also
Hello.
Sanlam team. Sanlam team, your hand is up. Okay.
Okay.
All right.
Everyone has understood.
Oh,
Very
okay.
nice.
Thank you. Thank you so much, Kevin,
Sure.
for that wonderful presentation.
Yes,
And
sir.
yes. Okay. Yes, Rachel. Okay. Right. Thank you so much, Kevin Katete, for the wonderful presentation and ably answering all questions. Thank you so much, our dear participants, for attending this session. It has been such a wonderful session, so interactive. Thank you. Our dear participants, we meet tomorrow. We have general insurance. Okay, we have fundamentals of insurance. We shall have fundamentals of insurance at exactly 11, and then life and pensions business will be 2 to 4. We meet tomorrow. Those who are doing general insurance and then life, we have it in the morning. That is 8 to 10 general insurance. 11 to 1, we have fundamentals of insurance, and then 2 to 4, we have life and pension business. Thank you so much for attending. Let me wish you a good evening. Bye-bye.